Right now, markets aren't being driven by one dramatic shock. They're being driven by a tension between slowing growth and inflation that hasn't fully disappeared, between investors who want rate cuts and central banks that are moving carefully, and that tension is what's moving everything. In the United States, the conversation has shifted. It's no longer how strong is the economy, it's how quickly is it cooling. Recent business surveys show growth slowing to its weakest pace in months. Manufacturing has softened. Services are no longer accelerating. The economy isn't collapsing, but the momentum we saw before is clearly fading. At the same time, inflation progress hasn't been perfectly smooth. It's not surging again, it's not out of control, but it's uneven enough that policymakers can't just declare victory. That's why every new data release feels so important. Markets don't just trade what's happening today, they trade what central banks will do next. If growth looks weaker, traders start pricing in faster or deeper rate cuts. Bond yields fall, equities often react positively. But if inflation comes in hotter than expected, those rate cut hopes get pushed back. Yields jump, the dollar strengthens, risk assets wobble. The bond market, especially shorter term yields, has effectively become the steering wheel for everything else. Now look at Europe and the picture shifts again. Inflation there has cooled more noticeably, even dipping below target recently. Policymakers have acknowledged downside risks, including the impact of cheaper imported goods, particularly from China. That creates a different dynamic. If inflation is easing faster than expected, the European Central Bank has more flexibility. So now we have divergence. The United States is balancing slower growth against still uneven inflation. Europe is balancing softer inflation against modest recovery in activity. And when policy expectations diverge, currencies move. Money flows toward the region that looks relatively more hawkish or less likely to cut aggressively. That's one reason the dollar has remained supported, not because the US economy is booming, but because relative rate expectations still matter. Then layer in geopolitics. Oil has become sensitive again to headlines, particularly around tensions involving Iran and the broader Middle East. Even without a full supply disruption, the mere possibility of escalation can push crude prices higher, and when oil rises, it doesn't just affect energy markets. It feeds into inflation expectations, it influences bond yields, it changes how central banks think about risks. Energy acts like a volatility amplifier. At the same time, Europe's long-term shift away from Russian gas continues to reshape energy supply chains. It's not something markets react to every day, but structurally it matters. It affects industrial costs, competitiveness, and inflation sensitivity over time. Under the surface, equity markets are adjusting constantly. When yields fall, growth stocks tend to benefit. When yields rise, the tone can shift. Investors are reacting quickly to changes in rate expectations, and that creates sharper, faster moves. Credit markets aren't flashing crisis, but they are attentive. Volatility isn't extreme, yet it's high enough that positioning and risk management matter more than they did in calmer periods. This isn't a smooth, straight-line rally, it's a repricing environment. Small surprises can create big reactions because expectations are finely balanced. Central banks have made it clear they are data dependent. That means every inflation report, every business survey, every employment number has the power to shift the narrative. So what should you be watching? Watch the details inside inflation reports, not just the headline number. Pay attention to wage growth and services activity in the US. That's where inflation persistence tends to show up. Watch Eurozone business surveys alongside inflation trends. If activity stabilizes while inflation continues to ease, That strengthens the case for policy support. Watch oil prices and, more importantly, why they're moving. Is it demand picking up or geopolitical risk being priced in? And above all, watch bond yields. They tell you how markets are interpreting everything else. The macro landscape right now isn't extreme. Growth is slowing but not collapsing. Inflation is easing but not fully defeated. Policy is restrictive but flexible. Geopolitics is tense but contained. Markets don't move on certainty. They move on shifts in expectations. And right now, the real edge comes from understanding how growth, inflation, rates, and geopolitics interact, because when you understand that interaction, you're no longer reacting to headlines. You're anticipating how markets will react to them.